This part is where many readers feel the real shock because it explains who actually wins and who quietly pays. You can publish this directly. How Speculative Markets Are Designed to Transfer Wealth, Part 3 of the series, The Trap of Speculative Investment and the Loss of Hard-Earned Money. The question most people never ask before entering any speculative market, there is one question almost no one asks honestly. If I make money here, who loses? This question feels uncomfortable, so it is usually ignored. Speculative marketing avoids it deliberately. Instead, it focuses on growth, opportunity, technology, freedom, and potential. But markets do not create money out of emotion. Money moves. When it moves quickly and unevenly, it almost always moves from the late, hopeful, and underprotected to the early, informed, and insulated. Speculative markets are not neutral playgrounds. They are structured systems, and structure determines outcomes. The myth of a level playing field. Speculative markets are often presented as democratic spaces where anyone can win if they are smart, fast, or brave enough. Charts are public, prices are visible, apps are accessible. This creates the illusion of equality. But equality of access is not equality of position. Participants enter speculative markets with radically different advantages. Some have early access, some have scale. Some have insider information, superior tools, or the ability to absorb losses without damage. Most ordinary participants have none of these. Markets reward position far more than effort. Early entrants don't need you to win. They need you to arrive. Every speculative boom begins quietly. Early participants take risk when attention is low and prices are small. Their risk is real, but so is their advantage. They enter before belief spreads. As prices rise, early entrants do not require the asset to become more useful or productive. They only need new buyers. This is the critical misunderstanding. Speculation does not need success. It needs participation. Late participants are not joining an opportunity. They are completing a structure. Their money allows earlier participants to exit at profit. This is not theory. It is arithmetic. Liquidity, the polite word for someone else's money. In financial language, this process is described politely as liquidity. Liquidity sounds technical and harmless. In reality, it means availability of buyers. Without new buyers, prices cannot rise. Without rising prices, early profits cannot be realized. Speculative markets depend on continuous inflow from less informed or later arriving participants. This is why marketing intensifies near market peaks. This is why hype grows loudest just before collapse. The system is hungry at the top. Platforms always win, whether you do or not. One of the most misunderstood aspects of speculative markets is the role of platforms. Trading apps, exchanges, brokers, and intermediaries earn through transaction fees, spreads, volume-based incentives. Their income does not depend on your success. It depends on activity. Win or lose, trade more. Volatility is good for platforms. Emotional decision-making is good for platforms. Frequent buying and selling is ideal. This creates a quiet conflict of interest. Systems are designed to encourage behavior that feels empowering, but statistically harms most participants. Influencers don't need your profit. They need your attention. Speculative influencers operate under a similar logic. They earn through sponsorships, referrals, advertising, course sales, social reach. Whether your investment succeeds is irrelevant to their income. Confidence sells better than caution. Certainty attracts more clicks than honesty. Admitting risk reduces engagement. This does not require malicious intent. The system rewards behavior that amplifies excitement and discourages restraint. Influencers exit emotionally before you exit financially. Institutions play a different game. Entirely large institutions, funds, and professional traders operate under rules retail investors rarely see. They have access to leverage at lower cost, advanced data and analytics, risk management teams, the ability to hedge, the ability to exit without visibility. When institutions speculate, they do so as part of diversified strategies. Losses are absorbed, offset, or written down. For ordinary participants, losses are personal, concentrated, and destabilizing. Retail investors are not competing with institutions. They are interacting with the aftereffects of institutional decisions. Why smart money leaves quietly. Speculative narratives celebrate boldness and conviction, but real winners often display neither publicly. They leave quietly. They reduce exposure gradually. They stop promoting. They avoid drawing attention to exits. They allow enthusiasm to peak without participating in it. By the time ordinary participants feel confident enough to enter heavily, the risk has often already shifted onto them. This is not because retail investors are foolish. It is because timing is asymmetric, the mathematics of many losers and few winners. Speculative markets do not fail because everyone loses. They fail because too many lose too much. A small number of large winners can absorb the gains of thousands of smaller losses. This imbalance allows success stories to exist alongside widespread damage. Those stories are then used to justify the system. If someone won, the opportunity must have been real. But opportunity that requires mass loss is not opportunity. It is redistribution. Why risk is always understated at the top? Risk feels lowest when prices are highest. This is one of the most dangerous illusions in finance. Rising prices reduce fear, falling prices increase it. But true risk often increases silently during periods of comfort. When everyone feels confident, there are fewer buyers left to support prices. When enthusiasm peaks, vulnerability is greatest. Speculative markets invert intuition. Heck, ordinary people don't lose because they're wrong. They lose because they're late. This distinction matters. Many retail investors are correct about technology, trends, or long-term potential. They lose not because their beliefs are wrong, but because their entry point is misaligned. Speculation rewards being early, not being right. By the time belief becomes widespread, advantage has already shifted. The emotional cost of being the exit. When speculative losses occur, they do not feel like market outcomes. They feel like personal failure. People blame themselves. They question their intelligence. They hide their losses. They internalize systemic outcomes as individual mistakes. This emotional damage is rarely acknowledged in financial discussions, yet it is one of the most enduring costs of speculation. Money can be rebuilt. Confidence takes longer. The system does not collapse, it cycles. Speculative markets rarely disappear after a crash. They pause, rename themselves, rebrand narratives, and return with new language. Participants change, structures remain. Those who suffered losses are replaced by new hopeful entrants who believe they will behave differently. The system does not require deception, it requires forgetting. The hard truth. This part leaves you with speculative markets are not broken. They are functioning exactly as designed. They reward early position, scale, and detachment. They penalize late entry, emotional attachment, and necessity. This does not mean speculation should never exist. It means it should never be confused with a reliable path to security. What comes next in part 4